Good day and welcome to CBRE's Global Insights. I am Raymond Torto, CBRE's Global Chief Economist and host of Global Insights. My guest today is Abigail Pitzner, Global Economist for CBRE. Abby has been with us for almost 3 years working on all things global. She has her degrees from the University of Wisconsin. Currently, Abby is working on a second master's degree at the University of Denver. Before we turn to today's discussion, I should mention that the PowerPoint for this discussion is available online at cbre.com, and the audio is available on the CBRE iPhone and the iPad applications. Welcome, Abby. I'm glad to have you with us today.
Well, thank you, Ray, and hello, everybody.
Okay. You titled your talk, Where is the Office Market Recovery? What is this all about?
Yes, so I titled it, Where is the Office Market Recovery? Because the analysis that we're going to look at looks at a number of different global markets, and it shows how bad their recessions and rents was and to what degree or how much they've recovered or even expanded.
Why did you pick the topic? Why is this important, you think?
Well, I think it's very important to have a perspective of where markets are standing right now, and it's definitely helpful to utilize that perspective to see where they are relative to a previous benchmark, and in this case, we're using the pre-crisis peak benchmark. So by using that perspective, we're able to see how far they fell, and we can do a lot of great comparisons, cross-market and cross-region comparisons from those statistics.
Do you have a summary of what you kind of found looking across the global markets that you looked at?
I do, yes. Well, one of the things that we found by using this analysis is that I was able to group markets according to the phase of recovery that they fall into. And we're going to cover those groups a little bit later, but basically we're finding that the vast percentage, actually about 70% of markets that we chose to feature in the analysis are actually still falling in the recession and recovery phase of the cycle. And so clearly we still have a ways to go until we can say that the global office markets are really in having recovered or expanded.
Okay, well, let's get into your presentation so you can give some meat to these words, recover and expansion and so on.
Sure.
So I'll let you go.
Alrighty, so I've included this first schematic just to make sure that we clearly describe the terminology that we use. And so the decline from pre-crisis peak to trough is the recession phase. And then we've got the trough phase, which I mentioned just because sometimes markets experience that phase where they bounce along their bottom level, and so they haven't quite undergone a more substantial improvement to be considered in the recovery phase. And then the period from trough back to pre-crisis peak is the recovery, and where we find most markets that we've selected. And then, of course, beyond recovery is the expansionary phase. And so again, as I mentioned earlier, we've created groups of markets according to the broad phase of recovery that they fall under. So you can see here that the recessionary phase and the trough phase are the group 1 markets. And then the recovery phase are the group 2 markets, and expansionary phase is group 3 markets. And so the great thing about, go ahead.
No, I'm sorry. I'll interrupt you here for a second. Any markets that you stuck? I know you covered 56 markets that you were looking at across the world. Were there any that didn't go into a downturn, had no decline?
Yes, there were 6 markets actually that didn't undergo any decline. So they might have paused a little bit, but they didn't really experience any measurable decline. And 4 of those were in Asia Pacific, and 2 actually were in Europe. So 2 of those were Geneva and Manchester.
Oh, interesting. Well, keep going. I'll let you go. I won't interrupt.
Sure. So one of the great things about being able to group the markets this way is that we can see where they stand relative to that benchmark historic point, but we're also able to compare the markets based on the severity of their recessions relative to each other. So that's really great. And then we can also identify some unifying characteristics of those groups. So let's get to the next slide here. So I started by showing the framework that allows us to see where these markets stand. And before I drop in all of the markets, I'll just describe the structure of this chart that I'm showing here. So the horizontal red axis down here represents the percentage change in rents recorded from peak to trough. So the farther to the left a market is on that horizontal axis, the worse their recession was. And then to see how markets shape up currently relative to their pre-crisis peaks, the vertical axis measures the percent change in rents recorded from peak to current. So all markets positioned above this 0% horizontal axis line are those that have fully recovered and entered that expansionary phase, whereas all markets below that line still have some ground to cover in their recovery phase. And also, it's really worth mentioning that there are several markets that haven't stopped declining or that are bouncing along their trough levels. And so these markets fall along this downward sloping diagonal line because their peak to trough percent change and peak to current percent changes are essentially equivalent. So they haven't started recovery. And so you can see here that, I've created these groups according to those phases that I just described. So if we move and zoom in and just look at the group 1 markets, the markets that haven't even started a real recovery, you can see down here towards the left-hand side that Dublin's rents, for example, remain roughly 55–56% below pre-crisis peak level. And as we all know, Dublin's market was just hammered by crisis as it witnessed a large influx of supply prior to crashing to its current levels. So again, remember that this group of markets hasn't emerged from their troughs. So Dublin's peak to trough is also 56%. Also in this group, not surprisingly, we have several southern European markets. You see Barcelona here and Madrid. And they've obviously are included in this group due to their ongoing sovereign debt crises and recessions and so forth. And there's some other European markets as well, stronger markets that while they've been plagued by tempered demand as a result of the broader European crisis, they haven't experienced nearly the drops in rents that you can see that Madrid and Barcelona have. Also along this left-hand side here, you can see Tokyo, and Tokyo has been battling recession and supply issues for quite some time, so its market is still clearly struggling. And then these other markets on this left-hand side are emerging markets, so they're witnessing more volatile growth, largely as a result of the fact that they're still becoming developed markets. So this is more expected for those types of markets. And then another market worth mentioning here is Atlanta, and you can see that it's the only U.S. market included in this group. And Atlanta has lagged the U.S. national recovery in terms of employment gains, and so it's suffered from chronic vacancy and still has quite a bit to go, over 10%, and stands over 10% below its pre-crisis peak level. So we have the next grouping of markets, which are our Group 2 markets, and these are the markets that have started some sort of recovery and have emerged from those trough levels. And we can see, again, that this group is a far more common scenario, as it constitutes most of the markets that we featured in our analysis. It was 38% of the markets featured are in this Group 2. And strikingly, you can see that the markets that we're seeing here are really the familiar key global financial centers and trade markets. You've got Hong Kong and San Francisco, New York, London. And one of the themes that we're often referencing throughout our other global outputs is the cautious optimism that occupiers have exhibited through 2012. And actually, this cautiousness has manifested in cost containment and decentralization for some markets. And so if you look at Hong Kong and Shanghai, both of those markets have seen some of that decentralization trend. And you can see here that Hong Kong stands 7% below its pre-crisis peak level. But as we can see from the horizontal axis, the market has actually seen an impressive recovery in that the peak to trough decline was upwards of 40%. So that shortage of space in Hong Kong and correspondingly relatively high rent levels has sparked some of that decentralization. Also, way over here on the left-hand side in this group, you can see Singapore is quite an outlier, and its rents fell dramatically. And you can see that they still have a long ways to go. And for Singapore, Singapore is known as one of Southeast Asia's premier financial and trading centers, and its economy definitely hasn't manifested a tangible recovery as of yet, as it's seen definitely prolonged recession, and both its domestic and external activity has collapsed and really has a long ways to go. And if you want to look at one other European market, for example, this is a unifying trend with some other markets as well. If you look at Paris's rents stand close to recovering their pre-crisis peak, and they're only just about 2.4% below their peak levels. And a large reason for this relates to the great interest that occupiers in the market have had for the best prime locations and the best space. And so that the supply of that space is scarce, so that dynamic has helped support the rental recovery in that market. And that's actually the case for London as well.
Abby, if I can interrupt you for a second, we're looking at your group 2 here. I see San Francisco, and I remember reading San Francisco over the last year had office rents increasing in the neighborhood of 25 to 27%, and people were talking a lot of chatter about that. But looking at your analysis, it has recovered clearly. Which is reflective of that increase, but it's still below the standard that you set, which is the peak, right?
Exactly. Yeah, that's such a good point, because I think one of the benefits about this analysis is that it provides a great perspective on really where things stand, prior to the global financial crisis. And another good example is Washington, D.C. Washington, D.C. witnessed really impressive demand and a recovery in 2010. And while the market certainly faces headwinds as a result of its connection to the government sector cutbacks and downsizing, the perspective of where rents stand relative to its peak is really great to keep in mind, because oftentimes people might not recall and keep in mind that it's still only 1% below that pre-crisis peak level.
But but looking at this group 2, where you got 21 markets, the previous group you had 19 markets, and the previous group was people that are still on the bottom, so to speak. So you got altogether 40 out of 56 of the markets across the world.
Exactly, we've got 70% of the markets that we featured still recovering, or not even yet recovering.
Yeah, so 4 or 5 years after the peak, because the peak would have been 2007, 2008, we're still recovering. And that's a long recovery period.
Yes, it is.
Interesting analysis. Okay, keep going. Sorry to interrupt.
Alrighty, so our next group is our group 3. And again, as we mentioned, this is a much smaller group of markets. And these are the markets which have fully recovered and are now expanding. And as you can see, all of these markets are positioned above that 0% axis line in our scatter plot. And we do have U.S. representation with Houston, and then there's 6 Asia-Pacific markets and a couple Northern European markets from Sweden and Germany, whose economies have held relatively firm throughout the European recession. And one example I definitely like to give is for Beijing, and you can see up here that Beijing has expanded by a remarkable 90%, so it stands 90% above its pre-crisis peak level. And Beijing is a really neat case study for China, because back in late 2008, early 2009, its vacancy rate was upwards of 20% as a result of a peak in supply. And then at the onset of the financial crisis, obviously, new supply tapered off and demand shrank. But then as the Chinese economy began to recover following the financial crisis, there was a whole bunch of pent-up demand felt from not only multinational corporations, but also domestic companies, both private and state-owned enterprises. And so this strong take-up helped compress vacancies to where they ended the year at 3.2% at the end of the year 2012 as a result of a lack of supply that was prevailed through the market as demand spiked up. So it's definitely a unique situation because many of other Chinese second-tier cities are seeing more concerns about future supply, and their demand conditions aren't nearly as large of scale. So Beijing is a unique circumstance. And then also in this group we have Bangkok, and Bangkok is also poised to see further rises in rents because they've seen healthy demand for grade A space and a lack of supply as well. So that lack of supply has not only helped Beijing, it's helped Bangkok. It's actually helped Jakarta. They've had tight supply. And then Houston, which hasn't expanded nearly as much, but it's certainly still expanded by 5%, has witnessed healthy growth in employment and led the U.S. throughout the recovery thanks to its employment to the energy sector. So that's another key trend to note. Not only do we have, the multinational corporation and domestic demand for those Chinese markets, but we also have links to the energy sector. So one last thing to mention as we're going through these groups of the scatter plot is that we have one group of markets that weren't included in the scatter plot at all because they didn't experience any measurable declines in rents, and so they never hit a peak. And we mentioned those earlier in the introduction. And these are the markets that just have continued to grow throughout the phase of everybody else's recovery. And so, as I mentioned earlier, we've got 6 markets that were in this group, 4 from Asia Pacific and a couple from Europe. And so the 4 from Asia Pacific were Adelaide, Kuala Lumpur, Seoul, and Taipei. And then the 2 from the European markets were Geneva and Manchester. And there's several unifying characteristics between these markets. For example, in Malaysia and Taiwan, they have strong domestic demand, and then the European markets have both seen more stability relative to the other European markets. And then one interesting point, too, is that Adelaide has actually been a bright spot for Australia, as many of its other markets have seen kind of a softening of conditions recently. And Adelaide has had strong links to its resource sector, so that's definitely helped improve conditions there. So bringing it all together here, we've taken our big scatter plot and dissected it according to the groups based on progress of recovery. And again, we've got our Group 1 markets that haven't emerged from their troughs along the diagonal line. And then we have our Group 2 markets, which are plugging along in the recovery phase. And again, the Group 1 and Group 2 markets collectively represent 70% of the markets that we're featuring. So that's a really important perspective to have. And then finally, we have Group 3 and Group 4 markets, which are clearly the outperformers across the globe. Group 3 markets having undergone a decline but recovered it, and then the other special Group 4 markets that just kept expanding throughout the crisis.
That's quite a graphic, Abby, you got there.
Yes, and one other thing I wanted to note, too, is that some of the average statistics, so the average recession that was encountered by the Group 1, Group 2, and Group 3 markets was a 21% peak to trough decline. And then the average progress or where markets are standing now on average is about 9% below pre-crisis peak. So I think, it's really interesting to think about as we're moving along the recovery to still recognize that markets are standing, 10% below where they were 4 or 5 years.
Average was calculated as a simple average, I would gather. Is that correct?
Exactly. Yep. Simple average. And one final slide here is, again, the great thing about utilizing this analysis is that it serves as a really great quantitative tool, but it also allows us to group the markets and then identify unifying themes between those markets and the same groups. And so just to summarize a couple of the themes that we've mentioned, clearly Group 1 can be unified by its markets' common economic headwinds. And then most of the markets in Group 2 are mature markets. They're the key financial and trade centers. And these markets, for these markets, we're increasingly finding that the stronger recoveries are connected to those markets with links to technology and energy sectors, as was the case for Houston. And another trend for Group 2 is the strong demand and limited supply of prime space. And so many of these markets occupiers are still cautious, but their preference for that prime space is helping the market's recoveries and at least supporting the current rent levels until uncertainty can subside further. And then for our Group 3 markets, which are the markets that, again, have expanded, most of these markets have witnessed demand from not only multinationals, but they've got that strong domestic occupier demand, and this was the case for Beijing and Bangkok and Jakarta. And another really notable thing is that these markets are in the midst of undergoing structural economic change. And so that structural growth with urbanization and globalization has really helped their fundamentals. And then last but not least,
overcome the cyclical. Yeah.
Exactly. So the Group 2 markets and Group 1 markets are in the process of experiencing that cyclical recovery as a result of the global financial crisis, whereas these other markets have really, for the Group 4 markets, they've been able to resist the global economic headwinds as a result of the structural change that they're experiencing, which is outweighing all of those headwinds. And one last point with the Group 4 markets is that many of them have links to the high-tech sectors as well.
Very interesting. Well, that's a good summary and a good piece of analysis. Do you update this on a regular basis?
Yes, we do. This is our second quarter of updating this, and so we definitely have plans to continue to do so, and clearly we'll probably be doing so for several quarters into the future.
So until the markets get above the line, huh?
Yes.
Well, hopefully that'll come along sooner rather than later. But
yes,
Abby,
maybe we'll be surprised on the upside.
Yeah, I don't think so this quarter, but let's hope so. I want to thank you very much for a very interesting analysis, and tell our audience again that if they're interested in the PowerPoint that you presented here, that is available at cbre.com. And Abby, thank you very much for making this presentation. Thank you.
Thanks, Ray. Have a good day.
All right. Bye-bye.
Bye-bye.